I think the best way to think about returns are you want to look at what the average return has been. You also want to look at the volatility of those returns, right? So when we look at, let's just say, take stocks versus bonds versus cash, right, over a really short window. Obviously, stocks have the highest average return, bonds are in the middle, cash are the lowest, but also that relationship flips when we think about volatility. So cash, pretty much what you have is what you're going to get at the end of the year. Bonds have a little bit of volatility, but chances are you're going to make a little bit of money that year. Equities can be up 50, down 50. Huge variations in a very
Oh
short
yeah.
period of time. But the really interesting thing is as you go further into the future, 3 year, 5 year, 10 years, 20 years, right? And 20 years might sound insane since we're talking about your retirement assets. But as you pointed out,
That's half a retirement.
life expectancy is getting you past that number, right? And the really
Yeah.
fascinating thing is when you compare just the rolling 20-year time frame, the average return in stocks is obviously the highest, but also the measure of volatility, which we're going to use standard deviation here, is actually even tighter than it is for bonds. So bonds have actually been a little bit more volatile than stocks. If you run the numbers and look back over a rolling 20-year time frame, there's actually never been a 20-year time frame in the US where stocks have generated negative returns. So if you can stick with it in those really volatile short-term time windows and you're investing long term, it may be the prudent thing to do to hold equities in a significant proportion in retirement.